I want to bring in David Nelson, Ken Mahoney, and Monica Mehta. Hope you guys loved my rendition of your favorite. So I know, David, that was your favorite show. Let me start with you. What is the message of these crazy markets? They're down, they're up, they're rallying big time. You blink, you go get a cup of coffee, come back, they're back down.
If there's a message, Charles, it's probably confusion, but don't worry about it. Wall Street is just as confused as everyone else. About the only thing we agree on right now is that the Fed is going to hike next month. We don't know how much. We don't know how many we're going to have this year. We're not even sure what the terminal rate is going to be. And in that mindset, in that backdrop, investors right now are just trying to figure out how much do you pay for some of your favorite names. The good news is there's still a winning team out there if you do your homework.
So, Monica, how do you buy in an environment like this?
I think this is a time to not be emotional. If there's stocks you like and you want to hold on to them for 5 or 10 years, continue to pick those up. Otherwise, you have to play the volatility and look for names that move a lot. And you know, that's far more risky, but that's all you can do in environments like this.
You know, here's the thing, Ken. At what point is the worst case scenario baked in? To David's point, we know rate hikes are coming. The market is tensed up. This is one of the biggest drawdowns in front of a Fed hiking scenario. So when is it enough?
Well, first I have to tell you, that type of singing, Charles, is going to land you on Spotify, so keep that up and see what happens.
Between me and Joe Rogan, buy the stock. That's all I'm saying.
Exactly. Hey, get yourself in the SPAC there, right? So, yeah, look, the Federal Reserve really has a credibility crisis. And I say that because, you know, Fed Chair Powell back in 2018 told us, hey, by the way, rates are going to go higher, and then had an emergency rate cut. He told us all last year that inflation is transitory. You can ask a 10-year-old and say, you know, inflation is probably stickier than that. And most investors have this concern that the next recession is not going to be caused because the economy slows down, inventory adjustments. It's because the Fed makes a mistake, and kind of here we are. So, look, I don't call for like everybody else is like a 6 hikes, 7 hikes, 8 hikes, some type of bidding war. We're in the 2 to 3 rate hike camp. We think more than that, the economy could buckle. You could start seeing the Treasury yield curve kind of flattening to maybe even inverting. Right. So at this point, we're in the camp that maybe see 10% more downside. We don't see some of these strategists down 40, down 50%. That's because they have 6, 7, 8 rate hikes in the base.
They're looking for them to actually kill the patient while they're trying to treat the fever here. So we're more than halfway through the earnings season. 2 things obviously standing out. The reaction to these results and the major shift in guidance. Now, of course, history shows us guidance normally is always guarded, right? Because it's easier for management to underpromise and overdeliver with these negative guidance. However, we're back to 2019 levels, and it feels like maybe something more nefarious has gone on here. Monica, how afraid are you because of this guidance?
I'm not putting too much weight in the guidance. I think at this point, generally, the people in the know are getting their advice from the Psychic Friends Network. Nobody really knows, and analysts would rather be vague than wrong. I think the one thing that I think is a sure thing this year is higher inflation. I don't care how much the Fed hikes or tightens. They're not going to be able to control the price inflation that we're seeing in so many sectors of the economy. And so if you continue to see this inflation, if you continue to see oil prices go up in the long term, you're going to have more volatility. So that's what you can count on, volatility.
I'm going to come back to you on oil prices, but obviously there's been a lot of carnage in the market, especially for those former sizzling pandemic names. Ken, I know from time to time you mentioned that you like some of them. I'm calling it the Icarus file. Is there anything in that Icarus file that you would be a buyer of today? Obviously, we see, for instance, Peloton. They had a kitchen sink kind of thing. Stock was down a couple of bucks, and then it was up 30%. Anything like that you're looking at?
Well, really don't like Peloton. I mean, it's a treadmill with an iPad on top of it. It's not the most innovative, disruptive thing in the world. You know, right now we're kind of hiding with the leaders, and we know it's a crowded trade. But you know, we saw these companies like Apple, like Microsoft, like Google, you know, beat estimates and raise earnings, you know, and guidance and so forth. And then you get the analysts to get behind it and start raising price targets, you know, go from hold to buy and those type of things. Unfortunately, those type of names, the ARKK, those innovation, Cathie Wood names, are really left in the dust right now because right now we're towards value. But by the way, Charles, the good news is at some point investors are going to be kind of bored with value growing at 2 and 3% top line earnings, and that pendulum will swing back. But we're not going to be heroes here. Right now, we'll take what we can get.
Hey, David, though, what about a name like, for instance, PayPal? All right, the CEO just bought $1 million worth of the stock on the open market. It seems like it's a little bit oversold to me. Does it something like that intrigue you?
Look, it's a good sign, but I wish it was 10 million. You know, Dan Schulman has a net worth of about 200 million. That would be a 5% hold in there. But like he said, it is a good sign. This is a major player in financial services, and with important breakouts in areas like Venmo. I use that every day, and now after this massive correction, it's trading at just over a market multiple. This isn't a bad entry point, right where we are right now.
Monica, you mentioned oil. You know, it wasn't long ago that there were calls for $100 West Texas Intermediate. That was considered the fringe call. Now it's conventional wisdom, and the fringe folks are at 150. Just your thoughts. You know, we came into the show, David talked about Iranian talks maybe going well. Is it too late to get into the oil trade? And if not, are there some specific ways to benefit from it?
No, I think oil definitely has room to run up. If back in 2020, oil and energy stocks were about 2% of the S&P 500. 10 years ago, they were double digits. I think they're going to be hitting 5%. So I think there is still significant room to move up. And you got to remember, we got to about $80 a barrel with China, one of the largest economies in the world, still shut down. All you need is a little geopolitical risk like Russia and Ukraine or China invading Taiwan, and you're going to see prices go up. Just Russia invading Ukraine could move prices by $7 all by itself. A cold winter, there's just a few little triggers, and you could see prices go. And I think that's what you can absolutely count on.
Is there like the upstream, midstream, downstream? Is there a particular way that's better than any other to buy it right now to take advantage?
I think right now, you know, there's a lot of different ways to play it, but if you don't want to break your head, just even an XLE or something that broadly measures the market, will see upside when you're potentially moving up that much per barrel.
Hey, Ken, real quick, other than where you're hiding out, is there something that you like a little bit more than others right now, other ideas?
Yeah, I like material, symbol XLB. Again, we're going through inflation. Companies that make things like DuPont, Dow Chemical, that's a place to look. I mentioned in the shows a few weeks ago, Zim. Again, they're logistics. And by the way, if you look at the California ports, we still have logistical problems. So I think those companies could kind of benefit. And then also play the scalp. You know, we're going to have some ugly days. You know, put some bids out there below the market. You may get filled and be happy with that. So, you know, you take what the market's giving you, and that's a lot of choppiness, and you just have to kind of adjust a little bit. That's the playbook now.
David, what about you? Your playbook, what's at the top of it?
You know, lately it's whatever's working, and today financials are working, and that's been a play that I think is going to have legs as the year unfolds. You know, right now, what would really surprise me is that the yield curve is actually starting to steepen. That's mother's milk to names like KeyCorp. Nothing sexy about it, but 3% dividend to boot. Strong name to be in right now.
Where, oh, where are you tonight? You know, now I'm going to have that earworm. I hope everyone has it with me because misery loves company. Dave, Ken, Monica, you're three of the best. I appreciate it. All right, folks, coming up.